Hello everyone, how's it going? So in this video, we're going to talk about AVCT, American Virtual Cloud Corporation. Currently, the market is going through a lot of volatilities and uncertainty, and in fact, a lot of selling pressure as well. And in this kind of environment, a lot of investors are looking for direction and sometimes hope. Volatilities sometimes is a very sharp double-edged sword, which can benefit and also cause us a lot of trouble. And in this case, we're hoping that things are going to go well for the shareholders. At least that's what the stakeholders are hoping for. And in the case of American Virtual Cloud, I would say that it's a tech company. It's a company that has been betting on the fact that people are using more and more virtual work environments. And they've tried to bank on this trend. Of course, this trend has been accurately spotted. However, what they've missed was how much capital this business requires and how long it takes before becoming profitable, if ever. So their problem was they're not big enough. They don't have enough money to tough it out. There goes a downward spiral due to, selling its own shares to pay bills and so on. So from 2020 to nowadays, it's a long and steady decline, in fact, where they were hoping that, first of all, the stock craze in 2020 is going to benefit them. It benefited in part, in a sense that the SPAC with which they reverse merged with in order to become a public company, it kind of collapsed when March of 2020 happened, meaning at the time the markets collapsed completely around the globe, because it was the beginning of the lockdowns. And as a consequence, they've never fully recovered from that. And this, in my opinion, is the beginning of the end, because whatever happened afterwards is just trying to catch up this early decline. And they haven't really succeeded doing so, because not only is the business, burning a lot of cash, they were also trying to game the expectation of the shareholders, so none of it really worked. And by 2022, so this year, a few months ago, they've decided to sell the whole business. So they've published a notice saying that, okay, so we now want to sell the entire company, or at least part of its assets, to whoever bidding the highest. So that is the current situation. Something to note here is that insiders are still holding their shares. They're not selling, either because this would send a bad message to whoever who wants to buy, or whoever who would want to buy, or they might be waiting for whatever happens after the buyout, because maybe the buyer is very generous. So this is in the air. It's not confirmed in any way whatsoever. There are some indirect indicators though. So both the fireside chat with Candy, one of its subsidiaries, or actually its only subsidiary that really counts in the current situation, they were talking about integration with Microsoft. And this could be a very weak sign that Microsoft is in the picture. So this is one thing. The other thing is a few reviews on Glassdoor were people saying, how the company seems to be great to work for. However, they're not very straightforward with the details regarding the sale or the buyout. And this would suggest that there is some player or some players in discussions with the company. And from the looks of it, it is at least an international company, so it's a big fish. We have to remember that the tech sector is fundamentally a volatile, uncertain, capital-intensive, but with high valuation. So there are a lot of deep pockets in the sector, especially the ones that have made it through the dot-com bubble and the dot-com bust. Microsoft is one of them. It's not the only one, though. So AVCT currently is in dire need of capital. Its going concern is not guaranteed, and it seems like time might be running slowly out. The fundamentals are as follow. Looking at its financial statements, it seems like its cash is going down. It has far less assets on balance sheet for sale. This is because they've also sold part of other things like their other subsidiaries and so on before that. So this might have an impact on how much they can sell whatever that is left for. The good news is most of the debt has been paid off using arguably capital raised by equity. So they're basically slowly liquidating their equity to make sure that the husk of AVCT can stay afloat, at least for the purpose of buyout. They have relatively high general fees, like sales of goods sold, and more importantly, it seems like the more advertising fees or expense that they incur, it doesn't really bring in more revenue. The loss has also been increasing, like their operating losses. So all these paints a mitigated picture, to say the least. Like, on one hand, business isn't going so hot. On the other, it seems like they won't have like a going concern issue from a purely technical perspective. What do I mean by that? Companies can have very bad years. They can have bad quarters. They can incur losses, so on and so forth. But what makes a company going under? Against their will, that is. In other words, unplanned going unders. This would happen if the company cannot fulfill its obligations to bondholders, to debt holders. In other words, if you cannot pay back money that you said that you would pay back, or at least interest that you said that you would pay to whoever who lent money to AVCT, then it's game over automatically. So this is a concern. A secondary concern is they've given about 100 million shares to a company called Hudson Bay Capital. And on October the 6th, there will no longer be any sort of limit for how much they can sell. Before that, it's above 30 cents pre-reverse stock split. They can sell how many shares, like unlimited amount of shares per day. Below that, it will be 10%, about 10% of their holdings. So this would suggest that even if the share price manages to reach higher places, there will be immediate additional selling pressure coming from Hudson Bay. So that is also something to keep in mind as we move forward. Finally, regarding the buyer, currently there is no serious buyer that is above the surface. I'm sure that there are some discussions with the tech giants, Microsoft, Amazon, Google, what have you. But the possibility that there will be some sort of fat cat coming in and, just give everybody a bunch of money to buy them out, it's a possibility, and I wouldn't say that it's unlikely, but it's something that we cannot keep as our only scenario. That's my point. So far, I've been talking about how the company is doing. Things that you can read in the news releases, news wires, their own websites, and so on. But the other part of our discussion here is this stock for you? Is this stock for anyone, in fact? In the current market condition, it's actually interesting to find a stock that is not really affected by what's going on overall, because it's relatively clear-cut what needs to happen for the stock to go higher. Some generous buyer showing up. That's what's going to result in a big payday for everyone owning AVCT. Okay? Currently, its share price is relatively low. It's relatively low, and from where it's going, it doesn't seem like a support has been found just yet. It also suggests that whatever happens on October the 6th, there will be additional volatilities coming in, either massively down or massively up. So this is what we know. And what we hope for is that the stock will jump up, right? Significantly so. But we cannot guarantee that this will happen. So what this means is that we have a stock which has not that many assets for sale, and they're hoping to get out of the whole business by merging with somebody else. That is like their end goal. And it's fun and all, okay? So if you don't own any AVCT shares at the moment, then, it doesn't really matter to us. They've made it clear that this is their strategy, and whatever happens, the play needs to occur within the next few weeks or month. Now, if it happens, then I would say that we can at least hold the stock until after the announcement, or maybe a week or two after the press releases. This is where a lot of expectations would build up, and this is also where retail interest would spike once again. If it doesn't go well, then I would say that we need to make sure that our position won't hurt our portfolio. And I'm personally willing to say that we need to leave at least enough space for like 50 to 60% of additional decreases. It's not going to necessarily happen. There's no reason to panic at the moment for like a dip of 50% of its value. But we have to be ready for that kind of volatility when it comes to this kind of company within that kind of sector and in the current time, if you will. Because why would a company not buy AVCT? It's because they don't have enough ready, cheap capital. During the QE years, when companies have a lot of readily available cash, they don't really care how much the company is worth, because as long as they can yield a percentage that is higher than whatever the interest is, it doesn't matter to them. Like, there are some countries just a few years ago where their interest was in the negatives, right? Even today, I think in Japan, you can get a business loan for 0.5%. Of course, that's inflation. I don't know if nowadays they've raised it or not, but last year, people can still get this kind of business loan for 0.5%. Some countries in the Scandinavian peninsula, as well as in Germany, could have gotten business loans at negative interest rates as well. Why? Because there's so much money flowing around that the central banks were saying, if the banks want to just eat the central bank's interest rates, then they have to go out. And how are they going to do this? Is by having negative interest rates. So my point is, a lot of capital was readily available not so long ago. And this is why a lot of those crazy purchases were possible. For example, Microsoft has bought Blizzard for almost $70 billion. Why are they willing to dole out that much money? Well, because they have plenty of money around. That is the thing. Same goes for Apple, by the way. I can't remember what the source was, but Apple apparently has massive cash balances in their offshore accounts. So those companies, they can afford to buy smaller competitors or companies that they think are innovative. And I mean, case in point, Facebook, in fact, is buying companies that are innovative because they can no longer innovate, right? So this is why companies would buy other smaller companies, but they wouldn't do this if cash becomes more expensive. Like right now, a lot of countries are giving interest rates for guaranteed deposits of 5 to 6%. Well, if that's the case, it's not a given that they're going to borrow out money just to buy a small competitor. If they're tight for cash, if they don't see like a lot of additional value for their current business. So anyway, this is just food for thought. I would say that if you fit the profile of a risk taker and you're willing to diversify your portfolio, and if you have the trade discipline to control your holding to within 1%, then you can go for it. In other words, even if AVCT crashes and burn, it's not going to hurt your bottom line that much. Okay, it's not going to screw your balance, if you will. It's not going to mess with your daily life. That's what matters the most. And I would say that the profit expectation for a play like this should be somewhere between 30 to 50% as a starting point. It could be 100%, right? So this is what we aim for. If they announce something like Microsoft is going to buy AVCT and they're going to come down sugar daddy style, then yeah, go for like 50, 100%. Not unlike when BNGO, so Bionanogenomics, received a lot of praises in scientific magazines, and you saw this company that was almost like just a penny stock going 10x. So this is the kind of situation that we're hoping for, right? If you want to buy AVCT. Now, if you're kind of iffy, if you're not sure that, this merger is going to go well, then it's very simple. You don't have to buy it. Anyway, so that is my recommendation for AVCT. If you're a risk taker, if you think that a merger is going to go well, if you think that somebody is still, rich enough or has pockets that are deep enough to buy a company like AVCT for a paltry sum for them, but a handsome return for the shareholders of AVCT, then go for it. Just remember, we're not here for the long term, right? We're here for the short term. So within the next 3 months, something needs to happen. It either goes super well and then we're out, or things crash and burn and we're also out. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.